Welcome to the London Business School Wheeler Institute for Business and Development COVID-19 series. The Wheeler Institute, we have decided to start a series focusing on the UK economy. And we want to start today with our two great friends and colleagues, Andrew Scott and Paolo Surico. Andrew has worked extensively on UK government debt. He has worked on inflation, employing both theoretical and empirical viewpoints. Paolo has been one of the leading voices working on household and corporate debt, again taking both empirical and theoretical viewpoints. So without further notice, the floor is to you, Paolo. Thanks for taking the time and being with us today.
Thank you very much, Elias. It's a pleasure to be here and an honor to start this inaugural event of the Wheeler Institute, a great service to the LBS community and outside. So I want to focus on household debt in the UK before and after the crisis. What you see here in this first graph is what is household debt relative to disposable income in the United Kingdom before COVID-19. We see a peak almost at 150% at the financial crisis. And now in the fourth quarter of 2019, household debt that is about, on average, 1.3 times the level of disposable income for a UK household. But as usual, as I've shown in my research of the last 15 years, the average effect, the average statistic masks a lot of heterogeneity. What you see in this chart is how the composition of household debt varies with the wealth distribution. On the left, you see in £1 billion for each decile of the wealth distribution, the composition of total debt through property debt, which is secure debt, and financial debt, most of which is unsecured. To take away from the left chart is that at higher level of wealth, at the top of the wealth distribution, the level of debt is much higher, and most of it is property debt. On the other hand, at the bottom of the wealth distribution, there is much less level of debt, and there is a larger share of unsecured debt. On the right-hand side chart, we learn about how levered are British households. Let's start from the top of the wealth distribution. Wealthier households in the UK, despite having most of debt, they have a level of wealth which is so disproportionately higher that they are very little levered. On the other hand, at the bottom of the wealth distribution, despite having less debt, because this is so much higher than their own level of wealth, households tend to be much more levered. A useful way of looking at the household balance sheet of the UK economy is to distinguish between three housing tenure groups, which are evenly represented in the British economy: outright owner, mortgagors, and renter. What I've shown in my own research is that it's very useful to try to figure it out how much is the level of liquid and illiquid wealth that they hold. Let me start with outright owners. Those are people that seem to be less constrained. Those are people that seem to face less liquidity problem. As you can see from the bottom panel, they have a significant amount of housing wealth, but also they have a sufficient level of liquidity, both the median, but actually over most of their distribution. Those are households that tend to be later in their life cycle, perhaps they're closer to retirement, just of the peak or immediately after the peak of their labor income. So a lot of liquidity and a lot of wealth. At the other extreme, you have people that are more constrained in terms of their liquidity assets. Those are renters. By definition, they don't have any housing wealth, but also if you look at their liquidity, the median is actually zero, with many of them which actually are in negative territory, implying that they are borrowing to live. And most of this borrowing is typically unsecured. In between, you have mortgagors, a very heterogeneous group. They have significant housing wealth, not as much as outright owners because they still have a mortgage to pay. But what is more interesting is that the median has a very little level of liquidity. But what is even more interesting is the heterogeneity and the dispersion. Some of those mortgagors have very little liquidity, typically because they've just started their mortgage. They have drawn down their saving to put down a significant deposit. And they are living as if they were hand to mouth not because they don't have credit assets, but because they have utilized all their saving and liquidity to pay down their deposit. On the other hand, there is also another group of mortgagors that have still a good liquidity. Those are people that are later in their life cycle, that have repaid most of their mortgage, but it's not all, and typically they face a much lower effective loan to value. So what I have shown in my research is that there is 1/3 of the British population that even before COVID-19 were spending most of the cash flow that they were receiving. We can go one step further and looking at the same data coming from the Understanding Society survey, which has asked people with different housing tenure how their financial circumstances were and how difficult they found to be able to getting along with their financial situation. What we observe from the answering of those questions that 50% of renters find it either very difficult or just getting by their financial needs. But even among mortgagors, there is a very significant chunk of mortgagors, 1/3 of them, that face financial difficulty. And this number is slightly above 15% for outright owner. And this is just before COVID-19. The crisis arrived, and let's see what has been the labor market and the spending implication for each of these three housing tenure groups. Let's start with the labor market implication. Both mortgage and renter has been affected, but in a very heterogeneous way. People with a mortgage have typically suffered in the form of less hours worked. Typically, those are households which have a higher income, which are highly educated, which are more skilled. So they're also more likely to be able to work from home. For renters, however, the problem on the labor market has come more in the form of either losing their job or a higher share of people that has been furloughed. In fact, what we know that people at the bottom of the income distribution, as you can see here on the chart, are much more likely, 7 times more likely, to be in a sector that has been shut down because of the crisis than people at the top of the income distribution. People on a low income tend to be younger, tend to be less skilled, tend to be renters. So again, a lot of heterogeneity in terms of the exposure across income distribution, across the housing tenure distribution, depending on how the crisis has affected you. How about spending? Well, what we have seen from survey data is that both mortgagors and renters is facing difficulty in their housing cost, in maintaining their housing cost. But this difficulty has been far larger in terms of housing cost, as you can see here on the left, for renters. Despite renters are facing more housing cost difficulty, renters are in fact has been less helped by policy intervention. Policy intervention has affected housing tenure mostly in the form of mortgage holidays. When it comes to renter, which is what you see here on the left-hand side, there were much little, if any, relief for them, and most of this relief has come through the form of private negotiation with their landlord. We can put together those information on housing cost on the information on non-housing expenditure, which is what I have done, developing this real-time indicator for the UK economy, together two excellent colleagues, Sinem Asioglu and Diego Kenzik. What you see on the left is the pound decline of average weekly expenditure by British household by housing tenure. The blue line refers to mortgagors, and the orange line refers to renters. The point to take away is that despite renters being more affected both in terms of housing cost and in terms of job implication, the ones that are cutting their spending most are actually mortgagors. This is not surprising because most of their consumption basket is made of non-essential goods and services. On the right-hand side, you do the same decomposition by income group. And again, what you learn is that the group that cut their spending most are the high income. Those are the ones that contribute most to the drop in aggregate demand. Again, this is mostly non-essential, whereas for middle and in particular low income, there is a limit to what they can cut because most of their spending is on essential. So what has been the implication of the drop in spending? Well, not surprisingly, as pointed out by the Bank of England, there has been a decline in credit card utilization. This means that for the first time in about 10 years, the amount of credit card repayment has exceeded the amount of credit card lending, simply because people are consuming much less and therefore are borrowing less relative to their repayment. But once more, the aggregate statistic should not fool us in appreciating the vast heterogeneity that there is across British households. What you see in this chart, again from our real-time indicator for the UK, is the saving rate for high income and for low income household in the UK. What you see in the green line is those are, we have seen it before, households that have contracted their spending significantly on non-essential basket and whose income has been affected by less. So if income is affected by less, but consumption is dropping much more, this implies that their saving rates is going up. They are using all the amount that they have not spent either to increase their saving or to repay some of their debt. Most of unsecured debt in the UK is utilized by mortgagors. On the other hand, we have the low-income household that already before the crisis, they were struggling. They were truly the standard, the classical hand-to-mouth. Consumption, this is saving rate, so it's income minus consumption over income. They were consuming as much as they were earning. So their saving rate was already close to zero. Then the crisis hit. There is a limit to what they can cut their consumption on essential, but their income dropped much more because they've been made unemployed, and therefore their saving rate goes into negative territory very significantly. Those are people that are borrowing to put food on the table. So what we have learned about the UK, the financing and spending position of British households. There's been a large aggregate consumption drop in the UK economy, driven by spending cut among mortgagors and high earners. Whose basket is mostly made of non-essential goods and services. On the other hand, the basket of renters and low earners is mainly made of essential, and therefore their smaller pound fall in spending has contributed less to the fall in aggregate demand, but significantly to lower their standard of living. Mortgagors, households with a mortgage, are less likely to have lost their job, and they have benefited more from government intervention, from mortgage holiday, despite only 1/3 of them, I have quantified in my own research, are likely to face liquidity problem. In contrast, renters have received little or no relief, but they are most likely to have lost their job of being furloughed. The drop in spending for mortgage and high earner has been used to increase their saving and to repay debt. And in April, renters have struggled so much they've started to borrow simply to pay for their consumption that exceed the income that they have made. And this is much for my presentation. Back to you, Elias.
Thank you, Paolo. It was a very fascinating evidence. So I urge our viewers to start posing questions. We already have some questions, but we had actually a question before even your presentation. And what is the policy implication here? You show a significant drop in consumption, especially for those households who are mostly in need. So what can perhaps the government do in those hard times?
So I think this is very important. This reveals how much an evidence-based approach on the microdata can really inform government decision. And let me give you at least 3 dimensions in which this could help. For example, there is no such a thing as rent holidays. It will be useful for those renters, especially those that are struggling in their consumption. It will improve significantly. For example, those renters will be afforded a renter holidays through a mortgage holidays. And I give you a very specific example. There are a lot of buy-to-let mortgages that can apply for a mortgage holiday, but it's not obvious whether and the extent to which they pass through their mortgage holiday as a rent holiday. The government could allow mortgagors to buy-to-let to apply for a mortgage holiday. They can already do it now, But they can do that under the conditionality that that mortgage holiday is fully passed as a rent holiday for their renter. There will be no cost for the landlord, but there will be an immense benefit for the tenant. Which goes back to the point of mortgage holidays. Now is offered virtually to everybody. And I think that there is an evidence now mounting up that probably there are more people applying for a mortgage holiday than they actually need. But the FCA have very detailed information on the characteristic of those individual mortgages and would have the ability to identifying those mortgages that actually are vulnerable group. I give you two very simple examples. We can figure it out what are those that are facing a lot of pressure in terms of debt servicing to income ratio. Essentially their monthly installment, their monthly mortgage payment relative to their income. And the regulator with some macro-proof policy might decide that above a certain threshold of this debt servicing to income ratio, then it might trigger a mortgage holiday. This will make it much more effective, the utilization of this type of intervention. It will cost less to the government and to the lenders, and at the same time will maximize the effect of this policy. The third point that I want to raise is that the problem that we face is that the people that are suffering more are the poor, but the ones that are contributing most to the fall in aggregate demand and consumption in particular are the richest ones that actually are increasing their saving. So the question is, how could discourage them to save and to put money back to the economy? But an obvious way of doing this is through a wealth tax. Where by wealth tax, I mean surely financial wealth would be even better, but we know that sometimes this is difficult to track down. So an obvious one will be housing wealth. Now, what I have shown in my own research is that whenever you tax housing, you want to be very careful to distinguish between gross wealth and net wealth. And for example, one possibility could be for the government in the future to use a tax of net wealth, the value of your asset minus the debt that you have secured on that asset. And we have shown that by doing that, the government can significantly increase revenue while minimize the negative economic effect on consumption. In fact, if there's something that we know as a public policy economist, is that housing tax, especially when they are on net wealth, they tend to be very little distortionary on consumption behavior.
Paolo, thank you. We are getting many questions about fear, about what are the macroeconomic implications of that, how will the government repay that. So I'm collecting questions, so please continue posing them. Actually, your last remark allows for a very easy pass to Andrew to our conversation. So Andrew, thanks again for doing it and joining us. So Andrew has worked a lot on government debt with a UK focus, also on inflation. He has a very fascinating historical overview. Moreover, he has done some important theoretical work on optimal government debt management. So Andrew, the floor is to you. So let's see if our viewers would like that analogy, like the mirror image of household debt or the other component of UK debt.
Thank you, everyone, for joining us. It's great to see so many people interested in macroeconomic policy. And of course, I'm thrilled of your interest in fiscal policy, which, whereas 2007-8, the financial crisis, the main focus was monetary policy, fiscal policy takes center stage right now in terms of what is happening economically. From my own point of view, my work is on government debt and mortality longevity. So there's an awful lot happening in my research areas right now. But here's what I'm going to try and do in the little time that we have available. I'm going to just briefly look at what's happened so far to UK government debt. Then I'll look at what should happen from a theoretical point of view. I'll then look at the issue about how high debt can go, and I can see from the various questions that many of you are worried about that, and then think about how the debt can be repaid longer term. So let me just begin by what has happened, and these are numbers taken from the Office for Budget Responsibility, just giving you a size of the impact already on the UK economy. So on the left, we got cash receipts to the HMRC, the tax authority. The yellow line shows you last year's outcomes. The tax year starts in April, and this shows you how receipts built up over the year. The blue dashed line is what the OBR is expecting, and that first diamond is the first number we've got for what happened in April. Look at the scale. We're already quite a bit short of what was expecting, and we can see we're expecting something like 150 billion down on tax revenue. This one here shows you central government expenditure. There's also local government, but in the UK, central government is the biggest component. And of course here, what you're seeing is the outcome is worse than last year. It's spending more. So you've got a big increase in government expenditure and a big reduction in tax spending, which then brings us to the third one here, which is the net cash requirement. Just a couple of issues on governments, and I'll try not to get too involved in the detail here, but a lot of government statistics are normally quoted on an accruals basis, so you sort of, not a cash flow basis. And that's going to be really difficult in the current time, given the uncertainty about what is happening. So I think it's probably best to look at the cash requirement. And if you look at that first April month, the government was expecting not to have to borrow if it was compared from last year, but instead it's had to borrow around $62 billion. And you can see the borrowing requirement is immense for this year. So what's happened? UK government debt has jumped to its highest level since 1963 in terms of its ratio to GDP. So I'll go back to a much longer history series later on, but here you see this decline in government debt. Then you see this jump again, 2007-8 with the financial crisis, this long increase, and now another big jump. And I want to just a little bit about this big jump. I'll come back to it later. We refer to this as a recession, but there's something very unusual about what is happening now. Normally a recession occurs and it builds up momentum, but this is a very sharp, steep increase or decrease in various economic variables. It's going to have a different dynamic from past examples of major recessions, and we'll come back to that later. So what have we got? We've got the highest level of UK debt to GDP for 57 years. April was the biggest ever month in borrowing throughout all of history. They expected minus 9.8 billion borrowing, and it came out at 63.5. By the way, I'm sure you're familiar with that old saying, a billion here and a billion there, and soon you're talking serious money. These are staggering sums. So what is happening here? Well, there's been a big fall in GDP. So of course the debt GDP ratio will rise. Secondly, there are automatic stabilizers in the fiscal deficit, such that when GDP falls, you get a rise in expenditure and a decline in tax revenues. All of that leads to a higher level of borrowing. And then, of course, there's discretionary policy where government steps in. And of course, here what we're seeing the government behaving as is like an insurer of last resort. So through the various large company and company support schemes, it is leading to a very large deficit as it steps in and acts not as an employer of last resort, but as an insurer of last resort. So that's what we've seen happening. And in terms of where debt's going to, somewhere between 120 and 150% of GDP seems to me entirely plausible. I'm sorry to be so vague, but there's just so much uncertainty. I think precision is not a useful thing to say here, but clearly it's going to go higher. So what should happen? Should we be worried about this? And here I'm going to bring in a little bit of economic theory and to stress that debt should act as a buffer. You shouldn't have a target for debt. Debt is a way of responding to shocks that happen in the economy. I don't want to say that debt doesn't matter and it doesn't matter what level of debt you get to. It does, but debt is not your main thing you should be targeting. You should be worrying about the rest of the economy. And I made all these arguments in 2007-8, but particularly with the work of Reinhard and Rogoff, the idea was that debt should be kept below 90%. But that's not the case this time around, which I think is interesting. There's a very different sense about where debt should go this time around. But let's just very briefly look at the theory. Forgive me for putting an equation in, but this is debt today, and that's the debt last period. And so, of course, debt incurs an interest rate, so the debt grows. And then there's today's deficit, the government expenditure minus the tax revenue. Now, what should happen when you get a big shock is you should set your taxes to achieve long-run solvency. This is where debt is a buffer. You don't hurt the economy today by raising taxes when it's in a deep recession. You plan your taxes for the long term. And then, of course, government expenditure has to surge in this downturn, so you're going to get a big deficit. But the key thing is this big deficit is going to lead to a persistent effect on debt. The debt today is equal to last period's debt times 1 plus R. In other words, when you get a macroeconomic shock, even if it's 1 or 2 years long, it sets in play a debt dynamics that is very, very long lasting. And that's okay. In fact, the other thing this literature says is that debt is not what we call mean reverting. There's not some average level of debt that you should say that's what we need to get back to. In response to a shock, debt should show very, very long run swings. In other words, in response to a 1 in 50 year pandemic, it is entirely plausible that your debt should show a 50-year response. And just showing you some data that some work I did with Albert Marcet many years ago. This is just looking at how debt responds to a shock compared to other macroeconomic variables. And the way to read this is as follows. When you get a shock, eventually over time, the impact on other variables like GDP and government expenditure and revenue dissipates. It starts to reduce. You get a big shock and then the effect dies away. Because of this buffer role for government debt, you see this very long run swing that looks like it's unsustainable, but it isn't. In the long run, that is consistent with sustainable policy and is actually a good thing. Okay, so how high can government debt go? This is another chart of some research I've done. This is with Martin Ellison from Oxford University. And this is where we went back and we constructed a series for the market value of UK government debt going right back to 1694 with the founding of the Bank of England. So my goodness, there's an awful lot of things happening during this time period, various wars, Great Depressions, etc. Now, the number right now is probably at around about 100% of GDP. I said it could easily go up to 120 to 150%. If you look at this long period of history, that says we're kind of getting to the average level of government debt. Now, huge discussions about whether we can just look at this 300 odd year period of time and think it as one sample. But certainly there's nothing here that says, wow, we're in uncharted territories, we're unprecedented waters. We have seen this level of government debt before, and government debt has come down before. So, the worry about government debt, of course, is that there may be a point where you can't finance it anymore, and I'll come back to that later. But if we look at history, we're certainly not at that point yet. Secondly, we know that there is the support to come from the government, from the Bank of England through quantitative easing, whereby they're buying government debt. And the third thing is there really isn't any sign at the moment that government cannot issue debt. The April funding round had 2.5 times the bid compared to what was being sold, and they sold a 3-year government bond at a slightly negative yield. There isn't any sign here that right now the markets are saying, I can't finance this. Now, that doesn't mean there won't be, but when you're in the midst of this terrible pandemic, when you've got awful things happening to the economy, to be worrying as a priority that I can't fund this debt, given these numbers and given the history, seems to me to be the wrong priority. And there's even some good news because, of course, what we're seeing is lower interest rates, and that means the funding government debt is down. And a peculiar feature of UK government debt is how much inflation-linked debt there actually is. And as inflation comes down, the cost of financing that debt comes down. So here you can see the OBR's estimates of money saved through lower interest rates and lower inflation this year. And whilst it doesn't quite fill the sort of huge 150 billion gap we were looking at earlier, it's still saving the government about 10 billion by the end of the year. So there's some good news on interest rate cover. And then one other issue, I looked at debt to GDP ratio, but if you think of this as a firm, you'd say, well, what's the debt to revenue ratio? And of course, government taxation is around 35% of GDP. So we've currently got government debt at about 3 times revenue. Now, the way to think that is that if you then raise taxes by 1% of GDP and cut government expenditure by 1% of GDP, over the very long term, you can quickly improve your fiscal position. So how will the debt be repaid? Well, any economist will tell you there's 5 ways to bring the government debt down. One is you run future fiscal surpluses. The other is you just have very low funding costs so that the current debt doesn't blow up very much because you're funding at near 0 interest rates. The third, which is an important and a great way, is remember it's the debt GDP ratio we worry about. So as you get more GDP growth, that starts to come down. A fourth is to have inflation. Governments, I mentioned earlier about index debt, but about 75% of UK debt is nominal. It says, I'll pay you back £100 in the future. So inflation means I still give you £100, but the burden on the economy is much less. And the fifth and final one is default. There's a sort of emotional debate about one particular instance in UK history, but by and large, the UK has never defaulted on its debt outright, and I don't think that's an issue in this particular case. So how have governments over history repaid their debt? Prior to the 20th century, it was mainly through fiscal surpluses. After a major war where debt was very high, you would run a large fiscal surplus. Since the 20th century, that has not been the main route. Instead, what has happened is GDP growth has been the most important way of bringing the debt burden down, with a supporting role from inflation. Important to think about politically what changed. In the 20th century, who could vote was extended, and therefore you saw less political support for running fiscal surpluses. Beforehand, what you had was only a few people voted. They tend to be wealthy. They tend to be the people who held the bonds. And so they were keen on getting the money back, and they accepted some level of taxation. So political dynamics have changed. But let me just come back to that inflation term again. This is not terribly high inflation. Even a sort of 1% higher inflation over 20, 30 years makes a huge difference in bringing down the debt level. So it's not an inflation of sort of Zimbabwean type proportions or hyperinflation. Now, looking forward, what can we expect? And Paolo was talking about a wealth tax. If I was looking at obvious areas where governments will be looking later on, and of course, beforehand, they're going to have to do some more fiscal support of the economy to bring finances under control. I think the state pension, and particularly the triple lock, looks vulnerable. It was already looking expensive beforehand. And there is a debate that could be had here to say the economy has suffered to save the lives of older people. So therefore, we feel that we're going to start to reduce the generosity of state pension to do an intergenerational bargain. I suspect there'll be all sorts of looking at health budget, which is a big one, and saying, well, actually, can we shift to preventative health as a way of saving money? And of course, COVID has been an example where we try to keep people out of hospital to keep them well. And I think that'll be something that will be built upon. And then I think there's a possibility of a one-off solidarity wealth tax. Paolo was showing how wealthier households are saving a lot of money. Well, one way to get that money and then spend it would be through a wealth tax. But of course, this all comes down to political feasibility. And with a growing population who are older citizens, that'll be harder to do. And I don't expect to see any dramatic measures anytime soon. We will need to support the economy after, as we slowly get back to normal. And I think we'll see the St. Augustine approach to fiscal policy, which is, Lord, make me good, but not quite yet. And I also want to just come back to that inflation risk. You know, there is an enhanced risk of inflation, but really to worry about this unsustainability of government debt at this point in time, when we have so many broad challenges, really to me seems to be a wrong sense of priorities. So just to conclude, guess what? In response to the worst deterioration in the economy for 300 years, we've seen the biggest increase in the fiscal deficit. That seems right. Debt should take the strain. Based on historical data, there's certainly scope for UK government to go substantially higher, and the current low level of interest rates support that. If you want to bring debt back under control in the long term, the key to doing that is decent growth in nominal GDP. So that's real GDP plus inflation. And any change in fiscal policy going forward has to have growth at its center stage. We know already that austerity wasn't a great political way of bringing debt under control, but we really have to focus on getting nominal GDP growth coming. Undoubtedly, with a higher level of debt, inflation risks have risen. But as I try to stress, you know, inflation is not a key way of bringing the government debt under control. Its role, certainly in the UK, has been exaggerated. It plays a role, and it can be a minor increase in inflation over long periods of time. But high levels of government debt does not mean you will get high levels of inflation. My own take on the inflation scenario is that clearly the risk of higher inflation has increased, but at the same time also the risk of deflation has increased when it comes to COVID. And actually it's deflation we really have to worry about, because that then creates very unfortunate government debt dynamics. So at least in the short term, fiscal policy should not be constrained by the fear of higher inflation coming from higher government debt. Just want to finish on two sort of keynotes around this. The first is we are talking here about the UK government. The UK government has 330 years of track record, and it has the capability to borrow in its own currency. So these are, it is one of the countries that has the greatest freedom to let its debt roam a large. The second thing is to sort of note the unusual nature of this recession. As we've seen tax holidays, as the economy starts to pick up, you'll see a resumption of tax payments. And of course, people who have postponed paying tax will start paying tax. I'm not saying that will cure all problems, but it does mean you'll see a more rapid improvement in some of the public finances than we've seen in previous recessions where that hasn't been at work. So thank you. There's my whirlwind tour of where we currently are on UK government debt. Elias, I'm going to hand it back over to you now.
Thank you, Andrew. Thank you for very insightful remarks, and especially for the long-run historical overview, which is actually quite important, I think, for our viewers. So there were many questions, and I see more and more questions pumping in. Let me start with the one that actually regards to your last remark, Andrew, about deflation. And also our great colleague, Vanya Stavrakeva, was posing a similar question. Shall we be worried more about deflation and more about a Japan-style lost decades with very anemic growth, very high government debt, more than inflation? So I would like you, Andrew, to build on your earlier remark, and then I will pass the floor to Paolo because it also relates to his remarks.
Yeah, I mean, certainly, deflation would be really unhelpful right now. And, it creates so many challenges. I mean, Paolo can come in about what it means for household debt. But, deflation particularly is going to cause a problem for monetary policy because there's a limit to how negative you can go with interest rates. And it creates a very bad dynamics for government debt because, that government debt is fixed in nominal terms. But if you've got deflation, the economy is tending to shrink, so the debt-GDP ratio gets higher and higher and higher. On the plus side, interest rates remain at zero, but no, it'll be very much one to avoid. And I think it's going to be really hard to read the inflation numbers in the next year or two, because I think there's going to be massive sampling problems in understanding inflation. And for me, one of the things that's kind of unusual about this, Paolo was focusing on the demand side issues. We know there's a supply shock with COVID. There's also a massive reallocation effect happening with very big relative price changes. So I think, how we measure inflation is going to be very, very difficult. But certainly I worry about inflation in the next 2 or 3 years. That's something we definitely want to try and avoid.
Paolo, any remarks, especially on the household side, what the deflation risk would imply?
Absolutely. I think that Andrew touched a very important point. And here there is a distinction between the short run and the medium term. And this is where I think I see the research that myself and Andrew have been doing are really complementary to each other. If you look at our real-time indicator, there are two big lessons that you take. One is about the question that everybody is asking. Is this more a demand or this is more a supply? And the other one is about the relative price changes that Andrew is alluded to. Clearly, this has started as a supply shock, and going forward, especially the ability of people to work from home, this could have large supply side ramification. But at the moment, from what we can see in the data, it seems to me that the demand component is significantly larger than the supply one. And we have a few hints about this. Consumption has dropped far more than income, has started to drop much earlier than income. In fact, someone has raised one of these questions in the Q&A. What we have seen for the real-time UK indicator, that the drop in consumption has actually preceded of a few weeks what has been the lockdown measure. So I think that fear and uncertainty, which are typically demand shock, are going to play or are playing so far an important role. So this suggested to me that in the short run, the major risk is a deflationary one. And once the demand pick up and the government pick up, then I can see in the longer and the medium term, inflation to come back to be a more significant risk. In terms of relative price, again, by looking at detailed transaction level data, million of transactions per day, thousands and thousands of users, we can see what are the sectors that are gaining and the ones that are losing, not just in quantity, but also in terms of prices. And this was a very interesting question in which household demand and government debt at a short circuit, should the government think of subsidizing the sector that have lose out of the COVID-19 shock at the expenses of those sectors that have gained because of the COVID-19 shock, which are the ones that have gained: online shopping, everything that has to do with IT, in some part of the education, which are the ones that are losing, the one on services, especially leisure, hospitality, transportation. This is a very fascinating time in which we have to care a lot about relative change, both in the economy, in the household, and within the government.
Well, let me just start with the many questions that we're receiving about the sustainability of debt. We even had a question from Sullivan, our friend from Nigeria. Being a Greek myself, I sympathize a lot with his view on how sustainable the debt, the UK debt in this case is. And going back to Andrew's remarks, we have G, government spending. And here, actually, some of the questions we're getting is that people now in the UK love the NHS. Perhaps we need to invest even more on that. Perhaps we all came to realize how important teachers and schools are, so we need to invest even more of that. Paolo came up with a proposal that actually spending the year in the US, some US politicians advocated a lot, a wealth tax. So it means higher T, lower G, one way or the other. Plus, both of you referred to the need for higher growth. Actually, a friend posed a question that post-World War II, the UK economy had very robust and fast growth. But now also with the Brexit, which is another question that we are getting, perhaps it's very hard to see the impact of growth. And we also had the question, I will start with you, Andrew, which I try to bundle them together, on the aging profile, and given your work with Linda Gratton on aging and the 100-year life and your forthcoming book, what will be the implications here? So how can the government jumpstart the economy to have fast growth?
Yeah, and you know, I said earlier that 2007-8, everyone was terrified of government debt going above this sort of mythical 90% number, and I was firmly against it and very frustrated that people weren't listening, that debt isn't something to target. But this time around, I'm sort of quite pleased where we're seeing debt go to, but of course you do have to worry because there could be other shots coming down the road. And, you know, there could be other pandemics, there could be second waves, there's Brexit you mentioned, and then of course there's technology in an aging society. So, you know, if we focus on what's the impact of an aging society, one of the things that I focus on is what I call a longevity dividend, which is that if people are living longer and they're healthier for longer, that should be good for the economy. So how can we support healthier, longer lives and people being productive for longer? And, you know, that's where we get the longevity dividend. Now, I worry from this crisis because of it, because I think there'll be a lot of people whose pensions will be very adversely affected by this crisis. I do think the state pension will be reduced in its generosity. So the need to work for longer, I think, will have increased for many people, but we're going to see a very high level of unemployment. And I think that's going to be a really big challenge, how to get 50 or 50 plus carrying on working, because 100% of the employment growth in the G7 the last 10 years has come from people aged over 50. But that's been a world where unemployment's been quite low. And if you've got high unemployment, we know there's all sorts of ageism about hiring people. So I think it's a real challenge. Now, in terms of where does the growth come from? I mean, let me just say, I think irrespective of COVID, you kind of want to have pro-growth policies. And it doesn't take much to think about where are the headline areas. A green economy, something to do with AI, and something to do with healthy longevity. They're clearly sectors we need to focus on. I would just sort of add the following, though. I think we tend to think about big sort of giant internet IT companies, sort of unicorns, etc. I think we need to focus a lot upon quite small scale firms and entrepreneurship, because when we've got technology coming down the road, we can try and train people up for those jobs, but we also need to create the jobs for the skills that people have got. And particularly the impact that's happened in the service sector from COVID, I think we do need to focus on getting local entrepreneurship going. The second thing, and I'll be talking to Darren Asamoglu about this when we do a Wheeler Institute around technology, is making sure that we let automation augment people at work rather than automate them. In other words, increase their productivity rather than just get rid of them. And that's about playing around with the tax code, so firms have an incentive not to get rid of workers, to introduce pretty crappy, cheap technology that I always seem to get stuck on the phone with, but actually stuff that really makes a better job. And I do worry in the aftermath of this crisis that firms will move ahead with automation in a bad way.
Well, Paolo, if I was to come to you, if we were to focus on T, on capital T, you propose wealth taxes, but this is not particularly. I understand that according to the polls, it's a popular policy. Having spent this year visiting MIT, two candidates of the Democratic Party proposed some form of a wealth tax. Neither of the two got the nomination, although this idea is floating. So actually we got some questions. Can you think of alternatives, or can we have this wealth tax very targeted?
Excellent question. Before I enter into that, I also want to mention there was a few questions about small firm. I just wanted to allude to one thing that I will cover in the Wheeler Institute webinar of next Monday with Elaine Ray on small and medium enterprise in the UK. That there is a significant chunk of corporate debt in the UK that is actually associated with housing debt, not just corporate real estate, but also the own value of directors. And there is an interesting short circuit, so I will postpone the answer to the question on the effect on small business in the UK to next Monday. Back to your very important question, let me emphasize that the problem of a wealth tax, surely there are two issues. One is about political feasibility, and you alluded to that, which government might be able to do what and to what extent. And the second one, there is one of implementation. Remember, something that emerged very clearly from what I have shown on my own research on the UK is that there are mortgagors and mortgagors. There are mortgagors that are affluent and mortgagors that they have stretched themselves. That's why I think it's very important to do a tax wealth which is targeted on net wealth. Because what is the idea, and Andrew alluded to that before, now is a time in which you want to discourage saving. So how do you put this saving back into the economy if those people do not want to spend? And look, this is true not just for mortgagors, but is also true for people at a lower level of income, which despite having a low level of spending, might prefer to save as a precautionary motive in the expectation of a rainier day coming forward. So let me offer some ideas. Well, surely a policy that will discourage saving is the one of negative interest rate. Also bear in mind that policy like quantitative easing are likely to be least effective in this scenario, in which the high marginal propensity to save is concentrated in households with a higher level of wealth, with a lot of asset. A second policy that might work in the US, we have seen with some success used in the past as policy of tax rebate, in which households have received a check home to be able to spend on whatever they wanted. My fear is that because of fear and uncertainty, in this kind of environment, it might be very hard to convince people that receive a check to spend it. Because the natural instinct, as we have seen, will be to save them. So something that the government could creatively do is, rather than sending home a check, to send home a prepaid card with an expiry date. These will be able to probably achieve both at a lower level of income distribution to foster and encourage consumption, and making sure that this does not pile into saving, and therefore will be a trigger of restarting the economy. As something was alluded to, there are many small businesses in the UK that are very much reliant on cash flow. So we need consumption, we need to stop the demand crisis as the best way of putting sales and therefore cash flow back into the hands of small businesses.
So I want to go related perhaps to that. We have seen a couple of questions on helicopter money. So Andrew, what are your ideas here? And actually one of our viewers nicely make the point that the quantitative easing policies that follow the 2007-2009 financial crisis actually, if anything, magnified pre-existing inequality. So how can we think about QE in a world of high inequality and the fear of continuing growing inequality?
Yeah, no, I think that's right. I mean, I think, so obviously QE will continue, but the negative interest rates are a real problem. And you point to the inequality one. And of course, fiscal austerity and QE are very regressive. So if you have less fiscal austerity and try and use fiscal policy to focus where you spend, you could potentially try and unwind some of the QE effects. But no, negative interest rates is a sign that the economy is really deeply unhealthy. And I think, that's the underlying challenge. Now, whether that's due to secular stagnation or other factors is where the pro-growth agenda comes in. I think we're on the verge of, we've got AI coming along. I think we have longevity opportunities to be seized, but we have an industrial structure and a set of policies that don't yet allow us to exploit that. So what we're going to make sure is that when we have those coming along, we exploit them to generate growth. And that's the green economy. It's I don't like to use the word grey economy, but it's the aging society economy. And then it's making the most of AI and robotics. And if we get that right, we can get inclusive growth, and we can tackle secular stagnation, and we can avoid the challenges of inequality. But if we just keep focusing on negative interest rates and QE, that's not going to work. I think what's interesting this time around is QE is in the background. It was very much in the foreground of the financial crisis. I have to say, I always thought that we made an error with the financial crisis, in that I think by and large governments and possibly the electorate thought the solution to a financial crisis was technical financial policies. And I don't think it was. I think it was to say, why did we have the crisis in the first place? Where was the growth coming from? And how do we create that growth? So I hope this time around governments will learn that lesson and genuinely focus on a pro-growth policy.
Well, let me continue on this question. A friend is asking, actually is quoting George Osborne, saying that the deficit deteriorates UK competitiveness. Do you share this view?
The trouble with government debt in the UK is that I do get the risks. We don't want government borrowing to go too high. There could be a funding strike. Interest rates could surge. And clearly it does nudge down the exchange rate, the combination of easy money and large fiscal deficits. But I don't think that's a really, really big challenge right now. If I say, what should I worry about? Potential risk to UK competitiveness through a large fiscal deficit. That just seems to me completely the wrong way around. So no, I disagree.
Elias, if I can chip in,
please.
What I think where the household finance situation and the government finance situation really needs to meet is very much on this point that I wanted to emphasize. We have the rich and the wealthy that are saving a lot. Their saving rate is increasing, and they are lending to the people with low saving rate, with the people with low wealth, with the people with low income, which are borrowing. We have seen this phenomenon increasing in the last 15 years, and the preliminary results in the response to the COVID-19 crisis seems to have even amplified further to support further this dichotomy, this divergence between the wealthy and the rich saving more and potentially in the future lending more, and the lower wealth and the lower income starting to borrowing more and indebted more. This is where the government can really intervene. This is where the government can at the same time tackle inequality and divert all those resources into the pro-growth strategy, in the pro-growth policies that Andrew alluded before. Missing this developing on the household finance of the UK society and how the government can intervene straight to those issues to take advantage of these and make the best use of those resources is what is going to be critical. Understanding that household inequality and public debt are intimately interconnected. Missing that will be another missed opportunity from this crisis.
Well, my very last question to Andrew, we just have 1 minute, is I'm getting two questions, so I feel obliged to ask that. Does the government has the know-how, so do they know when the targeted interventions are needed in order to prevent or avoid the mistakes of the past?
This is about the level of fiscal deficit.
It's about more, it's a general, we're getting many questions about targeted interventions, and the question is whether the governments have the know-how on how to do those targeted interventions. Some of our friends, some policies of France or Denmark. So
absolutely no. I mean, it's easy to say just have pro-growth policies. I completely agree. You know, to my mind, we need a new social narrative starting, actually, which I think COVID may well trigger, actually, which is discuss actually what do we want to achieve from policies. It's been a long while, I think, since we've had a really broad-based social discussion about how we want our economy to function, probably since Thatcher in '79. And I think that's what we're likely to start to see. So it's partly about what the society wants, civil society, and what it wants to demand. And then, yeah, what is then the role of government? I think for me, when it comes to environment, aging and technology, those are three areas where there's lots of externalities. So there will be a role for government. That doesn't mean it's the government in the forefront actually investing in the firms and driving the industries. But critically, they will play a role to play in either regulation, in taxes and subsidies, or direction. So, for instance, the example I gave about automation, that's about, do you favour capital tax or labour tax? And if you give firms an incentive to invest in capital, guess what? They're going to use automation to get rid of workers. And I suspect that's not a good thing to do. So I think governments can certainly influence that decision in a way that is entirely appropriate.
Andrew, thank you very much. And Paolo, thank you very much for taking the time. It's a real pleasure and honor to have you here. To our viewers, as I mentioned in my introduction, this is the first of a series of UK economic-focused COVID-19 series of LBS Wheeler Institute for Business and Development. So we welcome all of you to join us on Friday. Actually, some of the questions that we didn't have much time to tackle about UK firms and management will be answered. We'll be very pleased to host Julian Birkinshaw, Professor of Strategy and Entrepreneurship at the London Business School, and John Van Rienen, who is a Professor of Management at MIT Sloan School of Management and MIT Economics. We all welcome you on Friday to be with us, and we'll have a series of very exciting events in the weeks to come, among others featuring again Paolo alongside Helen Ray, our colleague, and also hosting again Andrew Scott with Darren Acemoglu from MIT, discussing more about automation and aging. Thank you very much for being with us today.